Good afternoon, all, and welcome to our third webinar. Our focus today will be global equities. My name is Ben Narcissus. I'm the Director of Distribution at TAMIM, and I'm joined today with Global Equity Fund Portfolio Manager Robert Swift. Our plan today is to run the webinar for approximately 40-45 minutes, leaving us 15 minutes for Q&A. If you check at the bottom of your screen, there should be a space allowing you to raise questions during Robert's presentation. Robert will be more than happy to address them at the end. Also, be aware that the webinar is being recorded and we will send the recordings in the next few days. Disclaimer: we put this at the beginning of each webinar just as a reminder that this is not specific advice to you, but rather general advice only. For those who are not fully aware of TAMIM Asset Management, let me give you a quick introduction. TAMIM is a boutique investment management firm. We manage just over $220 million on behalf of around 500 clients. We focus on our endeavors in generating returns to our investors. We tend to look on those returns in a slightly different manner to everything else you have in your portfolio, and they're giving you some good diversification. We focus on three classes, being equities, property, and credit. Hopefully my accent is not too bad, guys. Within those assets classes, and specifically on the equity side, we focus on Australian investment solution and global investment solutions. Within the Australian solution, we have two solutions, being the small cap and the all cap, both managed by Ron Shamgar. Ron has run our Australian all cap portfolio for just over 5 years and has annualized just under 17% net of fees through that period. This puts him in the top 5 Australian equity managers over that period, according to Morningstar. The standout fact to me is that a $1 million investment made 5 years ago would now be worth $2.2 million. Ron Shamgar will be running the Australian equity webinars next Tuesday. That's June 25th. If you haven't registered, please do so. Our next one is the Mobility Fund, which is run by Ryan Mahan. Ryan used to be partner at Arbex Mobility Equity Fund. However, since November 2023, Ryan has joined the TAMIM team heading the same fund. The fund focuses on sharing, autonomous, and electrification. Since Ryan joined the TAMIM team in November, we have seen performance improving significantly to as much as 10%. We had the pleasure to host Ryan out of Denver on Tuesday for the Mobility Fund webinar. For those who did not attend, recordings will be available. Just drop me a request in the question box and we'll make sure you'll get it. Our next asset class will be the credit fund. We run this portfolio, which invests in private debt investment solutions. Fund has done exceptionally well, looking to generate on a forward basis over the forthcoming 12 months around 8.8 to 9% yield to investors, and that's net of fees. For those who don't know, Darren ran the Credit Fund webinar last week. Recordings are ready, so if you didn't have the time to attend, let me know and I will send you the recordings shortly. Finally, our property fund. Within our property fund side, we tend to invest in single assets. I like to tell our investors that we like to purchase assets that other people are running away from. Going back 5 years when we were buying shopping centers, people were telling us we were crazy and if we've never heard of online shopping. Then there was our office building we purchased in Adelaide. I think it was, have you not heard of people working from home? Overall, we believe in change, but strangely enough, we always go back to being the same. We currently tend to focus on office opportunities where we believe we can get those buildings fully leased, and I'm glad to say that we have been quite successful doing so. Just a quick example, our last purchase was Peel Place, an office building on Curry Street in Adelaide, acquired in 2022, just after COVID. We purchased the asset with 43 vacancy, and I'm happy to say that currently it's at 94% leased. Property will be the last of our webinars. That's going to be run by Jeff Tate on June 27th. Again, if you haven't received the link with the webinar invitation, please drop me a request and I'll send you an email with the link. With that, I will pass control to Robert. Welcome, Robert. Looking forward to what you have to say today.
Great. Thanks, Ben, and thanks to all of you who've dialed in to listen to this webinar. My name's Robert Swift and have the pleasure of working with TAMIM running the Global Equity Fund for several years now. As Ben has said, I'm going to try and talk for as little as possible to allow you maximum time for questions, and I promise to try and answer all the questions that I can. We've had feedback. I've done many of these with TAMIM, and some of the feedback we've had is the slides tend to be too long, too many in number, and too cluttered. So I promise to try this time to reduce the amount of clutter, and there are fewer slides than normal. I will try and keep the message very succinct. What we said last time when we did this in December 2023 was that essentially it was best to remain biased towards inflation hedges, the best of which, of course, is equities. Jay Powell, the governor of the Federal Reserve in the USA, had just made very, very soft comments, if you like, bullish comments about the likelihood of interest rate cuts this year. And he immediately caused a massive rally in risk assets. Those interest rate cuts haven't materialized, but I still think that the bias in all central banks around the world is to try and avoid a hard landing, a crash in asset values. So from here, our view is that interest rates may come down a little, but not necessarily very much. On the other hand, we still think that the risk return profile for equities is still better than that for bonds. Some risk is still cheap. That is what we said in December, and it still remains the case. The trick, of course, is knowing what kind of risk or equity risk to buy. I think our feeling 6 months after we said this in December is that we give ourselves a 7 out of 10. It's always dangerous to mark your own homework. We remained invested, but we've been very, very shocked by the narrowness of the market. Anyone who reads the financial press will know that it's all really been about one stock. Which is Nvidia. We had argued for a market to broaden out, and we'd argued consequently for a mid-cap bias, buying into profitable companies in the Russell 2000 index, for example, that were on very, very low PEs. We think that is still a good bias to have. The slides that I'm going to show you will actually, I hope, convince you that we're about to see a broadening out in the marketplace, and very much of what we see in AI has already been discounted. We still like our 7 themes. We're calling them, if you like, the Magnificent Seven. And of course, for a number of reasons, many of which are quite sad, we also add to that the defense stocks. It's pretty clear to us that defense spending is going to go up around the world. And that there's going to be more money, more revenue available to companies that work in this space, both hard and software. And we can talk a little bit about that as well, if you like. Our intention is to remain diversified. That's borne out very well with the long-term returns that we've generated. We like to have a number of bets, if you like, in the portfolio across a number of sectors. We don't like putting our eggs in one basket. And currently we favor the USA, Japan still. I was there recently, a couple of weeks ago, and not so much Europe for a number of reasons. Some of which are political, and those of you who've been following the news will realize just how precarious the political situation is currently in Europe. So we think there's going to be some kind of soft landing. We thought this was a pretty amusing slide to show you. It could be a soft landing with some bank runs. We've already had some bank runs, but we think those bank runs will be cauterized. The USA is the place everyone's looking for bank runs, but there's a possibility that they do occur in other parts of the world. In fact, one of the Japanese banks, Norinchukin, has just announced it's going to have to take a very big loss, which it will meet by selling a large number of its overseas government bond holdings to the tune of $60-odd billion. So we're not out of the woods in the banking sector at the moment by any means, but we do think there's a very good chance of avoiding an asset price crash, which would be a serious problem for all banks. The reason that we think we can avoid it is because it's very well known just how much money the banks have actually got to find to cover the losses they've got in fixed income securities. This chart here should show you the extent to which the banks are holding securities which are currently in their books at prices way above where they would clear in the current marketplace. So the lines that below, the columns below the line, give you an idea based on the FDIC, which is the US organization that administers banking regulation. You can see how much money potentially the US banks have to lose where they have to sell these securities. And so we know that the Fed knows this, and we know the banks themselves know this. And so consequently, given the choice between causing an asset price crash if they can avoid it, and letting inflation run a little bit higher than it otherwise would, we think that the answer is going to be that inflation runs a bit higher than it otherwise should. In other words, there's not going to be an interest rate increase from here, let alone an interest rate reduction. Real estate assets are under pressure too. These again are in the USA, and you can see how not only are real estate asset prices under pressure from things like work at home, but also changes in business models. Commercial property in the USA is under a little bit of pressure with vacancy rates rising, but you can see that they're going to have to refinance their debt. And there's a lot of debt that's going to be refinanced, and this refinancing will take place at much higher rates than they managed to achieve for their debt in prior years. So there's a couple of pressures on the banking system, and we think consequently central banks will err on the side of letting inflation run a little bit hotter. We think the best hedge against that inflation is going to be owning equities, profitable equities, ones particularly that pay you dividends. The challenges that central banks face, and we also as fund managers face, is that the macro data is, inverted commas, challenging, which is to say it's actually pretty much been heavily polluted by COVID, as well as one might say a degree of political interference. This chart here gives you one of the two levers that the federal bank is supposed to be concerned about, and that is the employment number. And you don't need to know much about the ADP versus the BLS, other than that one is going up in terms of jobs that are being offered and taken, and the other is actually generally trending down. This is the biggest gap between the two surveys that has been seen. And this gap actually means, of course, the Fed doesn't know which way to turn. Is the job market getting better? That's one of their two obligations, is full employment, or is the job market getting worse? Given the choice, the ADP survey is the better survey, and that's the one that currently shows the economy softening. So again, that would encourage you to think that interest rates are not going up anymore, and we may even have room for a cut later on this year. The BLS survey is, by some, reckoned to be quite political because it shows the Biden administration in a good light, and they use methodology that counts people doing two jobs as essentially a good thing for the economy, when of course it really isn't. Let's move on from that, because macro is not a big part of what we do. We very much focus upon stock selection. But if the Fed finds it hard to follow macro data now, then we can be certain that we should as well, since we're obviously following what the Fed is saying. If you think about inflation over the longer term, it can do some horrible things to your purchasing power. We show this chart to show you what a basket of goods looked like for $20 in the USA in 1998 and what it looks like today in 2023. Many of you should think about your horizon in the 20-year period from here, and inflation at 3, 4, 5% over a 20-year period is going to halve the value of your purchasing power. So you need to think about how to protect yourself against inflation. So the basket of stuff you can buy in 5, 10, 15 years is towards the left-hand side of this and not the right-hand side of this. How are you going to protect your purchasing power? The problem we face at the moment with markets is that it really hasn't paid to be diversified. Equity market concentration is much, much worse than it was in the dot-com bubble. For those of you who are mature investors such as myself, you remember the dot-com bubble was all about 5 or 6 companies. They comprised about 18% of the market capitalization of the S&P 500. Well, it's now at about 27%, where the top 5 companies account for almost 1/3 of the market capitalization. That, of course, can only be achieved by having very, very high PE multiples and the assumption by the marketplace that their dominance in terms of revenue and margin is going to be maintained, if not increased. So this is something that we think is a warning signal to managers who are betting only on one variable, which is the continued euphoria surrounding AI. Now, the returns of the index have been driven by these 5 or 6 stocks, and you can see the difference between the orange line and the blue line is very, very significantly bigger than it really ever has been in the last few years. The blue line is the equal weighted S&P 500, essentially ignoring the effect of large companies on the index. And since trees don't grow to the sky, and since there's a very significant PE multiple difference between the two kinds of indices, we still favor, as we did in December, we still favor having this mid-cap bias, if you like, favoring the S&P 493 rather than the S&P 7. So AI is worth talking about. There's a number of things about AI, one of which is going to be very positive for a broader market, and I'll get onto that in a second. But many managers now are essentially looking at stocks for mentions of AI in order to buy the shares. And management knows this, and management is quite clever about telling the buy side and the sell side about how they're going to benefit from AI, because management is incentivized to get the share price up. So you can see since the release of ChatGPT in November 2022, the number of mentions of AI by companies has gone up quite significantly, because on the earnings calls, they know damn well that the favorable comments will come in if they mention AI. Any data screening, any verbal data screening by managers that looks for AI as a mention is going to be somewhat bamboozled by this. And we think a number of companies are mentioning AI in an unjustified sense. If AI is so great, actually, then all companies benefit from AI. If AI is so good, more capital will go into generating AI software and hardware. And so competition will rise, which typically tends to reduce margins. And I think our view on AI is that you should be looking to invest in the picks and the shovels rather than prospect for the gold nuggets. And when we talk about picks and shovels, we mean companies that will benefit from what AI is going to produce. The AI tech premium is also going to narrow in terms of its earnings per share growth. This chart will show you over the next 3 or 4 years that the earnings growth of the AI stocks, Microsoft, Nvidia, Amazon, Google, Meta, the famous five, the earnings growth of these companies is going to come back more and more towards the median of the S&P 500. Put another way, why would you want to pay so much for earnings growth in the future when the earnings growth is going to be the same as the median stock in the S&P 500? Again, we think that you can pay much less in terms of a PE and still benefit from the absorption of AI. So if we see the electrification of the whole economy in the USA, which is heating, transport, data centers, essentially driven by the AI adoption, then there's going to be an increase in the power demand on the grid, which has not been seen in the last 2 decades. The US grid is going to experience 3 times the growth in terms of its use and generation capacity. And the US grid is not currently fit for purpose. So companies on the left that we have favored, such as Sterling Infrastructure, EMCOR, Constellation Energy, Quanta, and NGK Insulators, the Japanese company, these are companies that will benefit from a necessary massive increase in investment in the US electrical and power generation capacity. So there's a very good way to take advantage of what the benefits of AI will bring to society, but you don't have to pay much more than a standard market PE for these companies. Some companies like EMCOR and Constellation Energy have done particularly well. We remain happy holders of those companies. This chart shows you what the global data center power usage per year is going to look like. And there's a base case, which is the blue dotted line, and then there's bullish cases. You can see that the rate of increase is going to be enormous. And this is something that's going to have to be dealt with. Otherwise, we're going to see selective brownouts in the grid. The best way to take advantage of this opportunity, we think, is by buying a diversified portfolio of companies that are going to service, build, maintain, repair the grid. We're also going to have to see, I think, the rehabilitation of what you might call traditional energy as well as nuclear. This is because, despite what the IEA has been saying, this is because there is going to be quite a significant supply deficit of this kind of energy. And this is energy that's extremely flexible, very powerful, frankly, much, much better than renewables, which require storage capacity, which does not yet exist. And so we think oil and gas and nuclear is going to be a very exciting area in which to invest. At this juncture, we should say that we think coal is filthy stuff and needs to be probably eliminated from the supply, from the energy supply chain. But gas has been declared as clean by the EU. Gas is something that they have been overly reliant upon for Russia, and there's obvious reasons why that is now a serious problem for them. The USA has become a very big supplier of gas to Europe, and it's all coming out of Louisiana and Texas. And there's been a huge increase in the plants in Northern Europe, in Germany, Wilhelmshaven, to take this gas on. And we think that Europeans are going to say one thing about the move to 100% renewables and do another, which is better for their economy, and that is to remain reliant upon the supply of oil and gas, particularly from the USA, which has become a net exporter. The other thing that we wanted to talk about really in terms of its picks and shovels is that the energy transition, which is basically going to rely on electricity from windmills, from solar, and also from fossil fuels, it's not going to happen without more digging. You need metals, you need, for solar panels, you need metals, you need lithium. All of this stuff has to be dug out of the ground. And the investment in the mining and exploration area has declined as a percent of real GDP. And we think that has to turn around. There has to be an increase in the amount of prospecting and the amount of proving up of reserves. And just as recently as yesterday, we bought into a company in the USA called Schlumberger, ticker code SLB, and check it out. It basically does geodetic and geological surveys for exactly this kind of material that is needed for any kind of energy transition. It's also needed to maintain the existing energy supply. So even if we don't get as much growth as we thought we did from AI and data centers and electric vehicles, there is still a need for this blue line to go up. And when this blue line goes up, companies such as Schlumberger will see more revenue and the market will become excited about them. Now, I just wanted to talk briefly about why we remain diversified rather than trying to chase the gold nuggets. The red line shows you the capitalization share of the IT sector in the USA. It's considerably above the earnings share of that sector. So in other words, the market capitalization is bigger than its share of earnings. And what that means, of course, is that there's quite a big gap between the, the, the price that you have to pay to participate and the earnings you get. In other words, the PE multiple for this sector is very, very high. So a lot of what we're going to see in terms of growth is already in the price. The next chart I'm going to show you is that forward PE that I talked about, which is essentially the blue line at a very significant premium to the red line, which is the S&P average. That premium is as big as it was in 2000. Do we know what happened in 2000 when John Chambers at Cisco told everybody they were insane for putting his company on 100 times earnings? Currently, the IT sector on average is on 30 times earnings. That's expensive relative to an S&P, which is itself not exactly a bargain at 20 times earnings. If one were to look in the mid-cap space in the USA, you could buy good companies that are picks and shovels, that are trading on between 12 and 16 times earnings, which is a much more attractive proposition as far as we're concerned. Let's look at the energy sector in the USA. I talked about how we were going to have to see a rehabilitation of oil and gas. The opposite is the true from the tech sector. The capitalization share is much, much lower than the earnings share of this particular sector. Put another way, the PE multiple for this sector is much, much lower than the market as an average. And we find that attractive. The market is beginning to broaden out. This chart should show you how the contribution of the earnings growth from NVIDIA was last year in the third quarter at 40%, and it's now projected to be smaller and smaller. In other words, the rest of the market is going to show some earnings growth. This slide, if you like, is another way of showing what I showed previously on this slide here, where I talked about the extent to which the earnings per share growth premium is going to narrow on the mega cap tech in the USA particularly. So if you look at the market broadening out in terms of its earnings, our logic says that the market should therefore broaden out in terms of the kinds of companies that get rewarded for displaying earnings and dividend growth. So there are signs that the market is becoming healthier, and by healthier we mean broader. A market that relies on one stock is not particularly healthy. I've circled areas of the market that are less expensive and have less what you might call crowding. These are essentially the cheaper and unpopular parts of the market, and you can see that Japan is in there. Non-US stocks are in there. If you look down below, you can sort of see how actually even China and Hong Kong stocks are now appearing quite attractive. They are historically at low PE discounts. Earlier on this quarter, we invested into the teeth of the downward price moves in Hong Kong and China. We invested into Swire Pacific, which operates Cathay Pacific, but also has big real estate holdings in Hong Kong. And that was quite a brave thing to do, but has done quite well. Our natural inclination here is to tend to be buyers of China and Hong Kong and not sellers of that marketplace. So we like to look here at the marketplace that is less crowded and less expensive, certainly to the left-hand side of the line. And you can see the kinds of companies which you'd expect to see in the global portfolio should you be investing with us. My slides are frozen. Let's see if I can move it forward. Okay, I might have gone 2 forward. I'm sorry. Nope, 1 forward. I mentioned, along with the magnificent seven themes that we advocated for, that the defense spending was very likely to go up. The source of this chart hasn't been, or has been included. It's the rather bizarrely named Stockholm International Peace Research Institute, but they do a lot of work to assimilate stats on who's spending what on military expenditure. And you can see it's been trending up for the last few years. And in fact, it's going to go up further and further. The Japanese parliament, the Diet, has just approved defense spending in that country to rise to 2% of GDP from 1.4%. So if my maths are correct, that's essentially a 60% increase in defense spending in about the next 2 or 3 years. Germany is very likely to follow suit. And what Donald Trump said about NATO and the Germans and the French needing to spend more money, and he got laughed at for saying it, but it appears to be coming true. And of course, with AUKUS, it's very, very likely that the defense spending by Japan isn't the only part of that pact that increases its defense spending. We own General Dynamics, but we're also going to be looking at other companies in this space. One of the stocks we missed is Mitsubishi Heavy in Japan, but there's plenty of companies with the capability to meet the demand for the military software and hardware. It's a sad state of affairs, but I think it's very likely to be the case that this increases at a reasonably rapid rate. And again, the expectations in the share prices for these companies is considerably lower than that for the market average. Japanese equities I wanted to look at again. We have been very keen on Japan for a number of years. You could argue we've been too early. That's one of the bugbears that we have to deal with. But the Japanese market still is very attractive in terms of its forward PE ratio. There recently, I can attest that while there's a lot of scare about its demographic profile, there are plenty of people in Japan available to do jobs where productivity will rise. We stayed in hotels where it took about 6 people to get us from the elevator to the front desk. Those people clearly could be better doing some other job in Japan. And the demographic scare, we think, is actually looking at the wrong variable. If you were to look at productivity in Japan, it has the potential to grow enormously quickly. And one of the paradoxes about Japan is that a country that produces so much clever hardware is actually very, very backward in terms of its use of software in the digital economy. And we think that's something that's going to change. So if we look at the Japanese market, it is cheaper than the US market. We think companies are buying back their shares, and we see them buying back their shares to better use their cash flows. But we don't see a market that's short of earnings growth. This line above 0 shows you that earnings revisions in Japan go up and they go down, but generally revisions are currently going up. Japanese companies are reporting business conditions are quite good for them. And the next chart will show you that actually Japanese companies are generating revenue per share that is quite healthy. So we had a long period, obviously in 2010 onwards, when Japanese revenues per share weren't growing, balance sheets were very, very sloppy. But we can now see how revenue per share is rising quite nicely in Japan. So it's not as if you're buying a market with no growth. You're buying a market with a lot of change, which is quite cheap. And we think that's quite attractive. Of course, the market was so good last year and the first quarter that we expected some sort of a pullback, and we've got it. But most recently, we've been bottom fishing a little bit in Japan, and we recently topped up a Japanese semiconductor production equipment company called Advantest, and we topped that up in the global trust. And that's performed extremely well in the long run, but has had a setback in the last month or two, which we like. We like that setup so we can buy into weakness. That concludes my remarks. I did promise to try and keep my comments very brief and pithy. I'd be very, very happy to answer questions. We, of course, would be very happy to share the current positioning of the Global Equity Trust in terms of its sector exposures, in terms of its country or regional exposures as well. And I'd be very happy to answer questions that Ben will now supervise, I think, for us. Over to you, Ben.
Thank you, Robert. Let's address a few of those questions. There's a lot of talk about NVIDIA. Just wanted to see what are your thoughts on TSMC and Intel?
Yeah, TSMC is a stock that we should indeed be looking at. Intel is less attractive. They appear to be a couple of generations now behind TSMC in terms of bandwidth. It's not all about bandwidth, but with TSMC at 3 nanometers, it's very clear to us that the company is going to be a participant in this big adoption of faster chips, which is essentially is what AI is all about. TSMC is also going to be receiving quite a lot of money from the US government that's looking to essentially re-onshore a lot of the um, technology that was offshored into Taiwan and parts of China. And for geopolitical reasons, the USA is very keen, as indeed is Taiwan, to remove a lot of that intellectual capital from Taiwan. So yes, TSMC is a company we would probably favor it over Intel. And there are other reasons why we don't like Intel, but I won't go on too long about those. It's to do with the way in which they didn't invest in research and they spent a lot of their money buying their shares back to enrich management in the last few years. They're now putting their hand out for government money, which strikes me as being a bit unfair. But anyway, TSMC, yes, we don't own it. We've got a lot of other tech stocks in the portfolio, but TSMC we are indeed watching and would be positive about it.
Thanks, Robert. Next one, we're heading into the US election later this year. What are your thoughts on the outcome of the election and the impact on the equity markets?
I don't know really what to say to this. I lived in the States for a short 15 years, and when I left, it wasn't the country that I went to in the mid 90s. I think since I left, it's probably become more divided than ever. I think probably if you're rational, you probably are looking at a Trump presidency. One likes to think that he's learned some lessons with respect to his commentary and the way in which he deals with the bureaucracy in the USA. In terms of policy, we actually can't see a huge. I mean, the rhetoric is very, very different, of course, but in terms of policy, we don't see a huge difference between Make America Great Again and the Biden administration slogan of Build Back Better. If you recall, President Trump harangued Tim Cook to bring jobs back to the USA. He forced Apple to repatriate a lot of their cash that they were holding offshore so that they actually began to distribute that cash as dividends. Um, the Biden administration is essentially following a similar national industrial policy, offering subsidies to companies to bring activity back onshore. So we don't see a big difference in terms of the outcome between the two. Donald Trump likes spending money. Joe Biden likes spending money. So we don't see a big difference. There'll be a very big difference in the rhetoric. But I think we just default to the argument that with the debt levels where they are, neither administration, whoever wins, is going to want to endanger the whole system by causing a what Jim Chalmers has called a nut crunching recession. If anything, both sides of the US spectrum are going to favor modestly higher inflation over an asset price crash caused by interest rates that are too high. And so the outcome for us essentially is going to be a soft landing, but avoid investing in companies that don't make a profit because those companies will not necessarily get refinanced. I hope that answers the question, but we'll wait and see what happens in November. Get the popcorn and watch the show, perhaps.
I got here another one. Do you still hold all companies such as Exxon, and what is your outlook?
Sorry, Ben, I missed that. The oil companies.
Exxon?
Yes, we hold Exxon. We also hold Woodside. And we also have made a lot of money. We were quite brave and we bought CNOOC, which is a Chinese oil company as well. So that's been quite a big winner for us in the portfolio. We also own companies like Cheniere Energy, which is the company that distributes and liquefies gas for export from the USA Southern Coast terminals, ticker code LNG. And we also own gas and oil pipeline companies such as Enbridge in the USA as well. So generally speaking, we are quite heavily invested into the oil and gas marketplace in a diversified way. In other portfolios, we have Inpex in Japan, which is an oil and gas business as well. So those are the kinds of names that we own.
having just been overseas, I can tell you it's quite painful to be overseas with the Australian dollar where it is. In terms of hedging exposures, our philosophy is that from an Australian dollar base or any domestic currency base, you want to get typically want to get the benefits of the unhedged position, so that you're taking two risks. One is equity risk and the other is currency risk. If the Australian dollar were to fall to an extremely undervalued number, such as 60 cents US to the Australian dollar, we would think about hedging. But our natural position in the portfolio is to be unhedged and to take the currency risk as being an acceptable risk.
All right, thanks, Robert. We'll go to the next one. What are your views on the India growth story?
We sort of have kind of missed that story. I think our preference, given our concerns about Indian company governance, is that we'd rather invest in the multinationals that are benefiting from India than we would invest directly in India. There's a geopolitical dimension here, of course. India benefits from the fact that it's not China. And so for any company or government looking to get allies in the Asian region and looking to get a cheap and increasingly wealthy access to a cheap and increasingly wealthy labor force, India is now much more attractive than China for some obvious reasons. And so we see India continuing, but our concern would lie in the way in which Indian companies are not necessarily, they can be quite economical with the truth. And so our preference is to invest in the multinationals that are working in India and growing their business in India. The obvious one is perhaps Apple, in that regard, who seem to be systematically shifting their production from Foxconn in Taiwan and China into India. So there's a story there, certainly, but our preference is to buy the companies listed on the G20 exchanges.
All right, Robert, thank you very much. We're going to wrap it. Just wanted to say thank you for your insightful presentation. I know we've all gained valuable insights for your talk. Application forms and information can be found on our website, www.tamim.com.au, or you can contact Darren, Sid, or myself on 1300 750 007 or directly 0403 360 850. Reminding you all about the Australian Equity webinar next Tuesday at 2:30. Thank you again, everybody, for your time, and I look forward to welcoming you to the Investor at TAMIM.